When you're starting out at work, getting a pension is probably the last thing on your mind, but the amount of money I have to spend in my old age depends on the financial decisions I make today. Nearly 2/3 of people aged under 30 don't have a pension based through their work, and it's often because it's very complicated. Let's try and explain. For 30 years you pay your national insurance contributions, and that means you'll be entitled to a full basic state pension. I'll be 67 when I get mine, and that's only £97 a week, or just over £5,000 a year at the moment, and as a result, not very much. You're just going to have to top it up. If you're lucky, you'll get a final salary scheme or defined benefit. Now, this is a pension pot which is based on your length of service and also the salary you've got at the end of your working life, and this is a pretty good deal. Unfortunately, there's not many of these around anymore, so you're more likely to have to go for a money purchase scheme, also called defined contribution. Now, you put some of your salary into the pension pot, and your employer also puts in some money, and also there's a little bit of help from the taxman, a bit of tax relief. And all this goes into the pot, gets invested, and at the end you have your pot and you buy an annuity. That is a financial product that guarantees you an income for the rest of your life. Some people don't have a work-based scheme or choose not to join it. Instead, they'll get a personal pension. Now, with a personal pension, again, you'll put money in from your salary, but you won't get a contribution from your employer. You will, however, get a little bit of help in tax relief. Now, what happens with this is you buy this from a bank, building society, a pension company, insurance company. They will throw in everybody else's personal pension and invest that money. Now, the money you get when you retire, your pension income, will depend on the success of this investment. From 2012, there's a new scheme called Nest, and if your company doesn't offer a pension scheme, you could be automatically enrolled into Nest. Now, what happens here is you will put in a minimum 4% of your salary. Your employer will put in a minimum of 3% of your salary, and then there's a little bit of help from the taxpayer. It's probably worth thinking about it before 2012. That's because of the magic of compound interest, which means starting to save in your 20s will leave you much better off than starting to save in your 40s. And that will leave me much happier in my old age.